All right, it's 8:02 on the East Coast, so I think that we're probably ready to begin. Welcome everyone to tonight's webinar, where we're going to take a look at how the market has been performing in the veterinary services field for the first quarter. Just a couple of quick reminders here as we get started. This is meant to be an interactive event, and so if you've got questions, we love questions. We will answer as many of them as we possibly get to. The best way to ask questions is actually in Zoom's Q&A feature, where if you look at the bottom of your screen, there's a box that says Q&A. If you just type stuff in there, it'll save it all, and we will either answer that kind of in line with the presentation, or we'll certainly have some time at the end to field questions. And if there's anything that you feel like you're really curious about that's very specific to your individual practice, both Rich and myself are available at your disposal. You can book time with us. We will add our Calendly links to the chat box, and you can just go ahead and book with us. Just a little bit of quick background for those that have not joined our webinars in the past. Who is Ackerman Group? Who are we with? Ackerman Group is the largest broker of veterinary practices to corporate buyers in the United States. Since 2017, we've transacted deals in excess of $2 billion. So lots of experience across the entire spectrum of the field. We've done 200 practices here in the last 4 years alone. We're averaging about a transaction a week. And that's probably the most important stat that you see here, simply because it identifies just how current we are on the current market. We have some of the most real-time knowledge that you can find in the veterinary profession because of how frequently we're working with both buyers and sellers. We do all sorts of deals. We do both 100%. We help sellers with joint ventures. We've done a bunch of stuff with private equity groups. We have a very expansive network throughout the industry. So we're really in tune with what buyers are thinking about at any given time. All that in expertise and experience is derived from this entire team that you see here. It is one of the largest groups in the profession, and we rely on each and every one of these individuals to help us really have a great sense as to what's going on each and every day in the market for veterinary practice sales. We're actually going to be adding another individual tomorrow, and so we'll have even more knowledge at our disposal, but certainly the deepest bench, if you will, throughout veterinary services. Tonight's presenter. I have with me tonight Rich Lester. He's the CEO at Ackerman Group. A lot of experience in the veterinary field. Prior to becoming CEO at Ackerman Group, Rich actually founded one of the corporate groups, led that for a number of years, growing it from effectively 0 practices all the way up to 60 plus by the time he departed. A lot of experience in the healthcare vertical as well. And so certainly a rich understanding of everything that could possibly be on your minds as you think about the market for veterinary practice sales. And so with that, I will turn it over to Rich to lead tonight's discussion.
Thanks, Wynn. Appreciate the kind words. And as Wynn said, it's been a pleasure helping lead Ackerman Group, working with lots of veterinarians to help them figure out transitions and exit plans. And tonight, we're going to take a look at what's going on in the U.S. economy and sort of how what's happening in the economy impacts the market for veterinary services. Then we'll talk about the market that we're seeing for veterinary service businesses and how that market is evolving. And importantly, we'll present a bunch of data from all the deals that we've closed, so you can see, we get a really good sense of where the market is based on all the data we're able to collect from the 40 to 50 deals that we're closing a year. And then at the end, we'll give some advice on what we think's next for practice owners, depending on your situation, and we'll bucket different types of situations to provide a perspective for different owners. So what's happening in the economy? It's been a topsy-turvy economy since COVID hit, and we're sitting in a high interest rate environment, and everyone's been waiting for rates to decline. But to be frank, no one really knows when that's going to happen. And there's lots of anticipation that it's going to happen. People have been making decisions actually fourth quarter and first quarter of this year in anticipation of rates going down. but the fact is it doesn't feel like it's going to happen anytime soon. So I'm going to walk through 2 slides with 4 different charts to just sort of give you some perspective on what's happening in the economy, why it's happening, and more importantly, how it impacts you as a practice owner and us as a veterinary industry. So start with this chart on the left. The orange is inflation. And so during COVID, we saw a huge spike in inflation. It was up to at an annualized rate of 9% by mid 2022. And why did inflation spike during COVID? Well, the government was spending lots of money. There weren't enough people to do the jobs, and there was a demand for product and services, and there wasn't enough supply of product and services. And so when demand is higher than supply, prices go up, and that leads to inflation. And the blue line is interest rates. And so as inflation started, the Fed was really slow to react. They kept interest rates at near zero because of COVID, thinking inflation was transitory. Reality was it wasn't. And then as the Fed started raising rates, the things that you would expect happened. Inflation came down because as things cost more, the cost to borrow money to buy a car is going to slow down the number of cars that are sold, both used and new. And so we saw this rise in interest rates. We saw the slowing of inflation. The problem is we've kind of hit this pause or plateau. So over the last 6 to 9 months, interest rates have been held steady at around 5.25, keeping mortgage rates really high and borrowing costs really high. But inflation has sort of stagnated at this 3 to 3.5% level. And so why hasn't inflation slowed? Well, there's a few reasons. One, there's still not enough employees that out there. The job market is still really robust, and unemployment is still under 4%. And so we don't have enough people wanting to work. We're not having enough immigrants coming into the country who want to take jobs. It is a strong labor market, which keeps prices not artificially, keeps prices high, and inflation high. Then you've got a lot of world events going on. You got a war in Ukraine, which is keeping food prices high and oil prices high. You got a Middle East conflict that's causing all sorts of grief. And think about shipping costs, like to move product from one part of the world to another, that those costs have gone up because you got people in Yemen firing at cargo ships, and cargo ships are now being rerouted, and that costs more money to reroute them, costs more money to insure those products. So lots of sort of external geopolitical things are keeping prices up. So when will prices go down? Unclear. And so the chart on the right here was sort of what we saw. And so this is the monthly CPI. So high CPI means high inflation for a given month. And so this is Q1 of 2023. There was a big spike. And in the beginning of the year, most companies raised price, most veterinary practices raised price. So you expect to see a little bit of a spike. And then the rest of 23, inflation moderated and even was negative in November, December. And so there was hope in late 23 that prices would moderate. But January, February, March, we've seen companies say, hey, I still have some pricing power. I can raise prices. And inflation has come back pretty strong still in 24, which is why you're seeing this flatlined inflation and this flat line of interest rates. And then the other question is, when interest rates go up, does economic output slow? And GDP, or gross domestic product, is a measure of how much goods and services are produced and purchased. And this trend that you see annually in 2020 with COVID, GDP was negative, and we had theoretically a recession during COVID. But in 21, it bounced back really strong. And 22 and 23, especially in 23, despite high interest rates, GDP rose 2.5%. And so on the right, you can see interest rates and GDP. And finally, in the first quarter of this year, we started to see GDP slow down, which is, it was sort of 1.6% for the quarter, so it was under 2%. And so is that enough to start to have the Fed lower interest rates? Unclear yet. We need to see probably another quarter of slower growth. The question that policymakers and economists are worried about is, will we have a hard landing or a soft landing? And so what does that mean? And those are terms that get thrown around. A soft landing would mean that the economy slows but doesn't go into recession and interest rates start to come down. A hard landing would be interest rates went up too much, suddenly we have a recession and we have all sorts of problems. Unclear what will happen over the next few months. I think what is clear is that we don't expect interest rates to start to decline for at least 3 or 4, maybe even 5 more months. And that's not a good thing for those looking to sell their businesses per se. So the question is, when will interest rates go down? When they do, the tides will rise, but when will it happen? We just don't know. So that's the macroeconomic picture. Hopefully that was simple enough to understand. The world is a little bit of a complex place. Our veterinary services market is a little bit more easy to understand. And so I like this picture, which shows that, back in 2021, every waiting room was packed. Visit growth was enormous. It was, high single digit visit growth in 21. Now in 24, we're seeing waiting rooms less crowded. Visits have actually been declining, and that's causing a slowdown in the business and in our industry as a whole. So I start, first graph on the industry is from IDEXX on the right here, which tracks from practice management data that they collect. The blue line is revenue growth, and the orange line is visits or invoice growth. And what the chart doesn't show is, if you went back to 2011, you'd see a relatively straight line with little variation over a 9 or 10-year period, where revenues grew 4 to 6% annually and invoices grew sort of 0 to 2%. Very predictable, very stable industry. Then COVID hits and we have a dip, and then demand takes off with COVID puppies and people just having time at home and being worried about their pets and going in for visits. And so we had these huge spikes. And then starting at the beginning of 2022, we've now had 8 straight quarters where invoice growth has been negative. We thought maybe 1 year of negative growth would be normal given how much growth there was in 21, but we're now 2 years into it, and everything we've read and seen is that visit growth will still be negative in Q1 of 2024. When do we expect visits to start growing again? Hopefully end of this year or early next. Part of the issue, I think, has been that veterinary practices as a whole have probably taken too much price, meaning during these periods of rapid visit growth, people didn't have enough veterinarians, so they just decided, I'm going to raise price when I don't have enough time and energy to take care of everyone who wants to come in. And that, I think, has left a little bit of a sour taste with some consumers, and people aren't coming in as often. So there's some grappling that the industry needs to do to get visits back above 0 and start growing again. The only silver lining to 2 years of negative visit growth is, as you all know, we have a terrible shortage of staff and veterinarians. It's been moderated a tiny bit, not a lot, by this decline in visits. So with the decline in we sort of this peak and valley in sort of revenue and invoices, we sort of see the same type of trend when we look at how many hospitals were sold year to year over the last 6 years. And so the blue bars represent the hospitals sold each year, and that peaked in 2021 when visits were growing like mad. At over 1,000 veterinary hospitals were sold to corporate groups in 21. It declined to about 822, and about 523. So there's been basically last year, we had half as many hospitals sold as 2 years prior. So the market has slowed down a bit, and that's buyers have slowed down, sellers have slowed down in their interest in it. Just the little plug for Ackerman Group, our market share, or the amount of the percentage of deals that we have participated in, has gone up over the last couple of years. We were probably 9% of the market last year. So almost 1 out of 10 hospitals that were sold, we were the advisor on. We do expect to see a bit of an increase in 24 based on, one, the volume that we're seeing as a company, but two, in discussions with the buyers, some of them are ramping up activity, and the number of sellers out there seems to be growing a little bit. We'll get into why that is in a few minutes. So this chart is what's the average price from an EBITDA multiple standpoint that deals are selling at. And to take a step back, EBITDA is earnings before interest, taxes, depreciation, and amortization. It's a mouthful. What it basically means is how much cash does your business generate from operations? And it's a financial term that's used in valuation. And so think of it as cash profits that you generate. And then the multiple that's paid on it peaked in 2021 in the second half, where 14 to 15 times EBITDA was the average price we saw. The range back then was probably 12 to 18 times. And then as the economy, the COVID economy slowed, let me go back, valuations came a little bit back down to earth. They, in 23, were sort of at pre-COVID levels, where the average multiple was around 11 times EBITDA. And we're starting to see a slight uptick in early 24. And I'll get into why and what we expect in 24, and why there's been a slight uptick in valuation. But that uptick's good news for those who are looking to sell. The higher interest rate environment has changed how deals are structured, and in that cash is king, and a lot of the buyers don't want to give a lot of cash up front because they have to pay a lot of money. They have to pay a lot of interest costs to their lenders if they spend cash. And so what this chart is showing is, on the left, this is deals that we've done in 22 and 23 is an orange, the deals with less than 60% of the value paid in cash up front. And so deals with a lot less cash grew to 39% of the deals that we did in 2023. But really, on the other end of the spectrum, where a seller got over 70% in cash, those deals went up to almost 41% of the deals that we've done. And sort of the middle, 60 to 70% cash, shrunk to only 20% of the deals. And so what I tell people is that the offers that are out there being proposed are sort of a tale of the two tales, meaning there's a bunch of people conserving cash, offering not a lot of cash, under 60%, but there is a group of buyers who are willing to pay a lot of cash, 70, 75 to 80%. You just got to know who to call and who's paying a lot of cash and who's not. So a lot of differentiation in the deals that are being offered and what we're seeing. And then this slide is a really important one also, to talk about the new players entering the market and the evolution of the buyer community. So each bar represents how many buyers we sold practices to in a given year. And then the blue is the number of new buyers that had never bought from Ackerman before. And orange are buyers that have bought from us a bunch of times before. And so it's not unexpected that in 2020, when we were really active, we had 11 new buyers, and we were a relatively new company then. And in 21 and 22, we only had 2 new buyers each year. But suddenly in 23, we spiked to 7 new buyers again. And that's driven by the changes that we're seeing in the market. There's not a lot of barriers to entry to creating a veterinary services company. You need a CEO and maybe 1 or 2 other people plus someone willing to invest money in the business. And private equity firms are excited about the veterinary space still, and they continue to invest in new businesses. And we're seeing that as they buy more hospitals from us. And in 24, we've already sold one group of hospitals to another new buyer. We have letters of intent with two, maybe even, and hopefully by next week, a third new buyer. So in 24, we expect 4 to 6 new buyers to be working with us again. And if you're a practice owner thinking of selling, the message is there's lots of new buyers out there that you probably haven't heard of that are entering the market. And so really understanding who's out there and who's actively buying is really important. So that's the end of the graphs. Now I'm going to talk more qualitatively about the market. So as we said, cash is king, and people are doing and putting more structure into deals. And so what does structure mean for a transaction? It's a fancy word for saying anything that is not cash. So when people talk about, hey, I'm now an owner of some stock in the company that bought me, we call that top co-equity. That's owning shares of the buyer entity, and that's part of a deal structure. A joint venture is different than topco. A joint venture is when you own a piece of your existing clinic. So you may sell 70% of your clinic, you may retain 30%, and you get profit distributions, and you are still an owner of that business. And at some point in time, when you want to retire, you can sell the other 30%. That's another way to structure a deal, is to have a joint venture. And then we're seeing also lots of what we call contingent notes or earnouts, which are basically deferred payments, sometimes guaranteed, sometimes not. If it's contingent, it tends not to be guaranteed. You usually have to hit certain post-closing thresholds to receive those payments. And so with cash being conserved, there's more structured deals. And with cash being conserved in an environment where veterinarians are harder and harder to find, there's then lots more DVM retention incentives being put in place. And so if you're a producing seller and want to sell your business, you're likely going to be asked to say 3 to 4 years if you're a significant producer. And that's different than in 2020, 21, you were going to be asked to say a year, maybe 2 years. Now it tends to be 3 to 4 years. And then if you're a 3 or 4 doctor practice and you've got a couple of associates, odds are they're going to get some cash or some other incentives to stick around for a while. No one wants to pay you 10, 11, 12 times EBITDA and have your associates leave the next day. So there's going to be something in it for them. I think the other trend that we're really starting to see emerge late last year and this year is there's an insatiable desire for good practices out there. If you've got 4 or more doctors and $500,000 or more of profit, and you're in a half decent market, we will likely see 8 to 12 bidders for your practice. And so there is an enormous amount of demand for good practices. And if you remember in 24, we went to that value, what are the valuation multiples being paid? We saw an uptick in 2024, and that uptick is primarily from these better, higher end practices. The market for sort of, I'm going to call it the standard 2-3 doctor practice, 250 to 450,000 of EBITDA, those multiples haven't moved much. There's still demand, there's still buyers. There's not 8 or 10, but there's 2 or 4 interested buyers, and the pricing isn't moving up materially for those at this time. So what are some of our market predictions? Where do we think things are going? The economy has, the economy is sort of stabilized. Inflation has flattened, but it's still too high. The stock market was strong in 23 in anticipation of rate declines, but has pulled back a bunch since the rate declines aren't coming yet. We're just waiting for those interest rates to decline. And when you look at the buyers in the market, probably the most important trend that's happened is the buyers with more than 100 hospitals, they haven't been able to recap or sell themselves to new investors for about 21 months. There were tons of recaps in 2020, 21, early 22, but the market's been relatively dormant because of these high interest rates. But now you have a backlog of companies that want to sell, and it'll be interesting over the next 6 to 12 months as more time passes to see when they actually start going to market. And they were all hoping to go to market around now or in the next couple of months. As interest rates decline, it's not likely happening. The interest rate declined for a bit, so it'll be interesting to see what they do. But these larger groups are also driving the appetite for the top practices that we saw. And then from the seller side, we saw fewer high quality deals, meaning those A practices in 22 and 23. And a lot of them were sort of waiting for the 2021 multiples to come back. And I think that there's now an acceptance that those multiples will not likely come back anytime soon. So those better practices are sort of saying, when is it right for me to sell? And more of them are coming to market because there's a little bit of a backlog of them, those who waited, and the waiting for the lower interest rates and for the higher multiples hasn't paid off. So that's what we see in the market. So if you're an individual owner, what should you be thinking about? What should you be looking at? So a couple of slides on this. So first of all, this is an analogy that Gary started using a number of years ago, and I think is a wonderful one. When you as an individual are thinking about, when is the right time for me to sell? There's sort of three things to think about. What does the market look like? How do you individually feel? Like, are you ready to go through the process? It's an emotional and can be a difficult thing to do when you've owned a practice for many years. And then thirdly, how's the practice performing? How's your team doing? How stable are your doctors? And so we like to say it's rare that all three stars align, where you're ready, the practice ready, and the market's really robust. What we tell people is the market's not at the 21 highs, but the market's pretty damn good. Like 8 to 13 times EBITDA is a pretty good range of multiples for veterinary practices. Remember, they were selling at 5 and 6 times EBITDA less than 10 years ago. And so valuations are still strong and good. It's then more a matter of when your practice is stable and your doctor group is stable, that's actually a good time to think about selling, because you don't want to sell when you've lost a couple of doctors. But you as an individual need to also be ready to go through the process. So this is something, as we've talked to more and more sellers, that we just wanted to start highlighting. Like right now, there's a declining, but still a number of DIY or do-it-yourself sellers. And folks want to save brokerage fees. They want to feel like they can do it themselves. They get these calls from business development people. But we wanted to just sort of highlight like how the scales are stacked against you when you do this yourself. So on the left side, you've got sort of all the intellectual capital that the buyers have. They have out in front, they have these really nice business development people. They're great salespeople. They build relationships with you. They make you feel like you're going to be taken care of. But behind the scenes, they've got financial analysts to pick apart your data. They got lawyers to figure out how to structure deals in their favor. And then they've got senior management and, as importantly, private equity investors who figure out how to structure deals that favor them, not you. Like, don't ever think that the buyer is looking out for your interests, even though they put on a smiley face and talk really nice. Like, they're trying to cut the best deal for themselves. And the people on their boards, the private equity investors, what they do all day long is do deals. And they may talk about win-win, but they're not really looking at win-win. And if you don't have a good advisor, you've got yourself. You may have a lawyer with a little bit of experience in the legal side, but not as much in the deal structure and valuation side. And most accountants who you may rely on don't understand the history, which accountants tend to be historians who look at historical data, not at figuring out how to analyze and think about the data. And so if you're thinking of selling, what we always tell people is the one important thing to do is get good advice. And we'd love you to work with us, but you should work with a broker no matter what to get help, because it's a once in a lifetime thing. We have varying advice for different aged and different style owners. So if you're a 60-plus-year-old owner, you should start to look at the sale process soon. If you're 68 and you're still producing a lot of money, you're going to get a discounted value because of your age. If you're under 60, there's going to be no discount to the value because of your age, because the ability to work 3 or 4 more years should be good, assuming you're in good health. But the older you get, the less confident buyers are that you're going to maintain your health. And remember, a sale process takes 6 months. They're going to want you to work 3 more years. So you need to think about 3.5 years from the start of a process when you will have the optionality to retire. Selling and retiring only works if you're a non-producing doctor or a non-producing owner. Now, if you're not looking to retire in the next 4+ years and you're younger, you can pick your spots and you can wait for the market to get better. The market's pretty good right now, but you can wait and hope that it does get better. There's no harm in it as long as you enjoy running the business. If you're unhappy running the business, we would argue, like, you don't want to live life unhappy. You should get some help running the business and go back to practicing medicine. A+ practices, I've mentioned before, lots of interest, lots of value there. So if you have one of those, you should, and you are thinking of it, it's a good time right now in the market. And the final thing is, if you've got a hard to recruit market where you live and practice, if you're in a small town, if you're in a 2nd or 3rd tier city, you need to plan much further in advance than even the 3 or 4 years that some folks that we tell most people. And if you're a husband, wife, veterinarian in those smaller markets, you got to plan even further in advance, because finding doctors to replace you in these smaller markets is really hard. And folks want, if it's sellable, people want time to be able to find new doctors. And the final slide before I move to questions, or 2 more slides. In this market, good advice is more important than ever. Market knowledge is key. As I showed before, who is actually buying practices, and new group formation is happening all the time. You're probably not getting as many phone calls from buyers because a lot of them have let go their business development teams. And the names that you may remember from a year or 2 ago may not be buying practices. There are new names. And so working with someone who understands the market and who's buying and not buying, really important. The probability of closing a deal once you have an LOI has changed. And by that, I mean, if you lose a doctor between the LOI and close process, if the financials prove to not be as strong as they thought, there are what we call retrades, or people will change the terms on you once you've signed the letter of intent. And sometimes they'll walk away. And so it's really important to understand and have advice to figure out how to get a deal to closing. And then finally, lots of groups are using top co-equity. How is that valued? What questions do you need to ask about that? What questions you need to ask about all the other deal structure terms? Really important to get good advice on that. So finally, before I move to questions, and please start putting questions in the Q&A, Ackerman Group launched a owners-only conference last year in Denver. We had about 100 practice owners at a really nice hotel. We had great food, great educational sessions. We had no trade show floor. We're running our 2nd annual insightful.vet conference in September of 2024. Now it's going to be in Philadelphia. Same thing, 2 days of great CE. About 60+% of the content is about how to run your practice better. And then if you're running your practice better and you're more profitable, what does the valuation and sale process look like? We'll talk about that for about 30 to 40% of the content, including how to deal with your real estate. Financial planner will be involved. We'll have a veterinary lawyer or two helping out. And so lots of great sessions. Tonight is your final chance to get $100 off. There should be a link to the insightful.vet website that was just put in the chat room. And so that's the end of my discussion. And I'm going to now go to the Q&A. And so I'm going to go in the Q&A and answer a bunch of questions. So first question is, any thoughts about a single doctor practice? So I have lots of thoughts about single doctor practices. So the first thought is the likelihood of a corporate buyer buying it is low. The only time we see corporate buyers buying single doctor practices are if they have north of $1.3 million of revenue, they're in a building that can handle 3 doctors, not just one, and they're in a really good demographic. And that's a very small fraction of the one doctor practices. The majority of one doctor practices need to find another doctor to buy them. There are other brokers and advisors that specialize in the one doctor practice. We tend not to do a lot of that, but if you want us to make some recommendations, we're happy to have a quick call with you or anyone who has one doctor, and we can help assess what's out there and give you lots of ideas on what to do. But I want to just be realistic that there's just not a lot of buyers for single doctor practices. So second question, any comments on large specialty ER practice centers? Lots of thoughts on those as well. I have lots of thoughts on everything, just so you know. So with specialty and ER, so in the 2010s, they were the darlings. They were trading at much higher multiples than GP practices. They were growing 8 to 10% a year, and it was a great business. In that post-COVID, it's been incrementally more challenging for specialty and ER. The things that have happened are pricing was pushed really high by most specialty ER practices in 2021. And then they started paying their staff and their doctors a bunch more money because it was hard to recruit and retain. And then in 22 and really in 23, business slowed down and they have this higher cost structure and they're not as busy. And so in general, profit margins have shrunk at specialty ER. Now, if your specialty ER practice still has robust margins and good growth, there'll be plenty of buyers for it. I will say that the buyer set for specialty E and ER has changed a lot, and getting a good advisor to help you is really important because NVA is not buying too many of those practices anymore. Thrive Pathway is basically not buying right now. United Veterinary Centers, which also is a buyer of ER, is not in the market. So there's a bunch of new groups that are buying specialty and ER practices, but they may not be the names that you've heard of or known. And so there are certainly buyers. There are buyers for really good practices. And by the way, the flip side, while things have slowed in that market, the scarcity value of well-run specialty ER practices is real. Probably 75% of that market is now owned by corporate groups. So there's very few large independent groups left. So there will be lots of interest if it's a well-run practice. So hopefully that's helpful on the large ER side.
Rich, do you want to comment briefly on, specifically for Spec ER, the balance of revenue between the ER portion of the business and specialty and how important that can be for sellers?
Yep. So I would say there is a lot more focus on having a strong specialty business as opposed to the ER business has become a lot more challenging. So one, ER doctors are as hard or harder to find than specialists. There's been a lot of market share that's been taken away from the ER side of specialty ER by Veterinary Emergency Group. VEG has done a tremendous job in the ER only space. And there's also a lot of urgent cares popping up, and those urgent cares are open till 10 p.m. or so. And so they're taking some of the less complicated cases from the specialty ER hospitals. So ER in the specialty ER segment has not been as strong. And so buyers are more focused on strong specialty businesses as opposed to stronger ER sides. It's a hard, ER is just a harder business. That helped, hopefully. All right. Well, there's still a bunch of you out there, and no one's asking us that many questions tonight. Here we go. Just when we think we're done, we got more questions coming. We are thinking of purchasing a single doctor practice in a great demographic in order to expand our footprint and hopefully increase our value. EBITDA is approximately 20%. Thoughts? So a single doctor practice with 20% EBITDA margins is really good. I would ask the question, are you evaluating it properly? i.e., are you looking at profits after paying the doctor that's working there a normal salary? A lot of times when a single doctor is running a practice, they don't pay themselves a salary. And when you look at the EBITDA, it needs to include an adjustment so that you're paying that single doctor 20% production pay, because that's what you're going to need to pay someone else who works there. So that's one thing. Just make sure you're doing the valuation and looking at the EBITDA appropriately. The second thing is, if you've got a great demographic and hopefully there's a good building with this practice, it makes a lot of sense, especially if the buyer is a multi-doctor practice that can help recruit into that single doctor location and grow that location. We have seen a number of entrepreneurial practice owners buying single doctor practices, especially when those entrepreneurial doctors have had success recruiting doctors. There's no better way to grow a single doctor practice than to add a second doctor and then a third doctor. And so you got to think about the building, and you've got to make sure that you're able to recruit, and then you got to make sure you're valuing it properly and putting all the right expenses into that analysis. So hopefully that makes some sense, and good luck with that. And if you want to talk more about it, the person who asked the question, I won't name names, feel free to set up a time to talk to me. Happy to just have a 20-minute conversation to give you some thoughts on things like that. All right. Well, it is now 8:45, and we've had a handful of questions. We've had a good dialogue, and unless someone asks a question in the next 25 seconds, I'm gonna, there we go. Here we go. Next question. We now have potential new clients asking if we are independently owned. Is corporate vet medicine starting to face pushback? I'd say that the answer is yes, that corporate vet medicine is starting to get pushback. A lot of that is media driven, and a lot of that, some of that as well is appropriate, and some of it's totally inappropriate. And so people ask all the time, sort of, is this corporatization of vet medicine a good thing or a bad thing for the industry? And so I'm going to give you the 2-minute Rich Lester sort of balanced answer. So what's good about corporate owners? Well, there's a few things. Corporate owners tend to invest more in equipment, invest more money in physical plant. They tend to be better at making sure staff get annual reviews, annual raises. They tend to give staff better and more robust benefit programs. All of those things that I just mentioned cost money. And so corporate groups do typically raise price a bit more aggressively than individual practice owners. But we have seen on average corporate groups investing more into the clinics. And so it's, the media will give you this negative stereotype of corporate groups, all they care about is money. They don't care about the pets. They don't care about it. And that's, there may be some groups that are all about the money, but most people who are in management and helping run these companies really do care about pets and they really do care about providing good service. And part of why they don't raise price just to reinvest, they also raise price to make more money. But there are benefits to corporate groups that they bring to clinics. It's not all negative, is what I would say. So another question, you mentioned the building. We have invested a lot in facility with associated expenses and financing, but with room to grow for several years. Any comment on relative value giving this context? So that is a really good investment typically, especially if you're in a market where you will see growth in the practice. So the worst thing to do is have a very successful practice that's busting at the seams and there's no room to grow. Every buyer is looking for growth in the practice. And so if you don't have room to add 30 to 50% more revenue in your existing footprint when you sell, there will be a discount on your practice because the buyer is going to say, oh, I need a new building, or I need to expand the building, or I need to rearrange the building. And that costs money to do. And so the person asking this question who's done that investment, that's going to result likely in a higher valuation than if you didn't. So the second question, part of the question was, if we're considering sale in 3 to 5 years, should we hold off on new facility or service ventures that may take time to return profit? So what I would say is the key for your building, if you're going to sell in 3 years, is how much growth do you expect in the next 3 years? And will you still have room to grow more? And to be frank, if after the next 2 years you start growing so much that you're running out of room in your building, then you do want to make that investment because you will get a return on that investment when you sell. So the most important thing is to have, at the time of sale, room to grow. Now, other ventures that may take time to germinate, like, I don't know what you mean by that, but if you're thinking about opening a boarding and grooming type stuff, that doesn't get, I would argue against doing that if you have a strong veterinary services business. Boarding and grooming is fine, but it's not valued highly by buyers. If you're thinking of bringing in more specialized veterinary services that may take some time, I would encourage you to do that because the broader your service offerings and the higher quality medicine you do, people do pay an incremental premium for that. All right. That question's done. Any more questions? Or going. I haven't lost very many participants. Everyone's sticking around. So I appreciate you staying with us this long. And we've had a good group of questions. Would love to hear more questions if you have it. But if not, we'll finish up. So, all right. I feel like everyone's all questioned out, and need a drink of water soon because I've been talking for 45 minutes now. So I want to thank everyone for joining us. I want to remind everyone that if you have time, go sign up for insightful.vet. If you have interest in talking to me or talking to Win, please sign up and talk with us by Calendly or email or call me. So thank you for your attention and have a great rest of the evening.